And we're very excited to have the pleasure of speaking with David Morgan today. David Morgan is a widely recognized analyst in the precious metals industry and consults for hedge funds and high net worth investors, mining companies, depositories, and bullion dealers. He's a publisher of the Morgan Reports on precious metals, author of Get the Skinny on Silver Investing, and featured speaker at investment conferences all over North America, Europe, and Asia alike.
Well, it's been a challenging year for precious metals this year, but a real buying opportunity nonetheless in the last couple of months. Silver broke out of its 5-month downtrend last week, but as with gold, the move was unfortunately not confirmed by action in the stock market. What is your current position on silver and gold prices, David, at this point in time?
Well, my current position is we probably bottomed. I want to be cautious here. I've got a little better picking the tops on the way up than I have the bottoms on the way down, but nonetheless, we had a spike low recently where we actually got into the 14s in the aftermarket, the overseas market. Silver rallied substantially from there on very big volume. Key reversal, and those are called key for a reason. So, from all the data that we can see, and being in this market for so many years, etc., I really think the bottom is in. Having said that, I did forecast the rally that we had recently, which is off that spike low. I said we'd probably get to the 17th level and wallow around that level for a while, and the most likely scenario was to fall back off of that level. In the last few years, we've seen the metals trade into the last trading day of the year, establishing like the lows for the year. And that is probably a likely scenario here. I doubt we're going to see new lows in silver, possibly in gold. Gold started the year at around 1,200. We're roughly at 1,200 now. So, although it's certainly gone up and down year over year, in a way you get that reported in the mainstream press, it's going to show that gold is up a few percent or down a few percent if it remains near this level by the last trading session. Silver, on the other hand, is down significantly from the level that it started the year at, which is around 20. So, gold is obviously holding up better than silver on a year-over-year basis. As far as the overall equity market is concerned, the internals are extremely weak. And what I mean by internals is you have increasing prices on decreasing volume. And that is something that's not sustainable. And anyone that does even a cursory view of technical work knows that when you have that kind of underlying weakness in the market, that it isn't going to be too much longer before you'll see that weakness show up in the price structure. So I'm a little bit negative, or fairly negative, on the overall equity market, and I'm neutral to strong to bullish on the metals market. It's taken longer than I forecast, quite honestly. I thought after the big spike from the $19 level all the way to 48, I was lucky to catch the top two people from the about 30-something level on up. Please be careful buying these prices because, there's going to be, this is parabolic. It's going to end. It's probably going to end soon. And, make sure that you buy some maybe, but not all, et cetera. So I was trying to get the warning, even in the public domain, that, things are getting a bit frothy in the silver market. However, having said that, after the, finish the story, and I really thought, once the decline started, that the $26 level was probably going to hold, and it did for a very long time, and then it broke through that on very obvious manipulation. I mean, if you go and look at what happened at those price levels, $15.50 for gold and $26 for silver, the amount of paper sales was so astronomical relative to what the physical positions are. It was ridiculous, and yet certainly had a very large effect on price. And I think that was a psychological move as well, because once we broke that level to the downside in both gold and silver, a lot of people that had been bullish up to that point decided that things were not, right with the metals, regardless of what the fundamentals said, and they moved on to other asset classes, the stock market being primarily the beneficiary.
More of our interview here in just a moment. If you want to start investing in the meantime, 1-877-8-SILVER. Go to realmoneyshow.com and guildhallwealth.com. Click on the e-store. You can do that to start investing. As well, currently the promotion is, and take advantage of this, every 100-ounce bar of silver you purchase now, you'll receive one silver maple.
There is a lot to be said for what is happening behind the scenes versus what we see in the paper pricing. Recently, you've been discussing the fact that physical silver demand is up with record sales of Silver Eagles, Maple Leafs in 2014, and total silver industrial demand is forecasted by the Silver Institute is expected to pick up as much as 27%, and that could add as much demand as about 140 plus million ounces of silver during and through up till 2018. What do you see in terms of the supply and demand picture for the next couple of years yourself?
Yes, great question. Really right to the heart of the matter. First of all, let's talk about demand in two frames. One is the retail investor market, and the other is the industrial side. I'll break the retail demand down into the small collector, or small saver or silver stackers referred to. And these people are relentless in their conviction about the silver market, and I applaud them. And I'm probably one of them. Where I continue to purchase on a dollar cost average basis. I also do try to pick the lows from time to time, but I'm pretty cautious as far as not spending everything, saying, "Oh, this is absolutely it." I did buy at the recent spike low. I was not able to get in at that time, even though I tried. I was locked in about $16.25, which relative to the cost of producing silver is still very undervalued. But back on points, the one thing about the investment demand side is that the small savers continue, obviously, by the amount of eagles and maples and the silver rounds, etc., sold. But the institutional side has been very, very quiet. You haven't seen any big purchases by the Physical Silver Trust from Sprott. You haven't seen Central Bank of Canada make any silver purchases in quite some time. And I'm kind of looking for that. You would think, the fundamentals, in my view, of many haven't changed. In fact, they've actually improved, meaning that the overall global economy is certainly not doing that well, regardless of the mainstream press says. So for people that have not participated in the precious metals as either a hedge or a way to benefit with appreciation of the asset are on the sidelines. So there's a lot of potential new buyers that could come into the market, but the leaders in the market, so to speak, the institutional money really hasn't made a move here, even though the price levels are really very, very favorable to a longer-term investor. So I really like to see more participation, let's say, by at least one, if not more. And I think once one takes place, then you might see a follow-through by another one or two. But I am very clear about reasons why they may not be participating at these levels, because the price is very tempting. It has to do with the structure of the asset class, where they need to have a premium on their asset in order to be able to float the prospectus and go through the procedures as required in order to buy more. So in other words, if you don't have a premium in the Physical Asset Trust, PSLV as an example, they're not able to go into the market and actually purchase. So the fund has been actually at a slight discount at times and a slight premium at times. It's kind of oscillated back and forth. So, that's something I'm looking for in 2015. I think it'll take place. I'm not sure which one or both or more, that type of thing. The other one that's a little tough to figure out is the GLD and the SLV. The GLD has, had a pretty big offtake, whereas the SLV has actually had, more silver come into it. So there's, a little bit of discrepancy there. Of course, then you can, build the argument the other direction and say, yes, David, but if you look at the Singapore exchange and the amount of silver inventory that's once there and what's left, it's been depleted, in a very, very significant way, which is true. I'm just trying to get back to it. What I'm really seeing along about way, perhaps, is that the demand side for silver on the investment side is extremely difficult to figure out. I use the best studies in the world and, of course, my own analysis of my own connections. And so I'll state this. I think that the retail demand is strong, much stronger than the price would indicate. I think you take that as fact, although it's my opinion, but it's a very steady opinion. And then I think on the institutional side, I think we're just going to have to wait. But I believe the demand is still there, and I think that you will see it come into the fore sometime during 2015. Now, going to the industrial demand, if you go back better than a decade, the demand side for silver was roughly 35% of the market, and the last several years it's been about 50% of the market. So it's gone up, even while silver production has gone up. But it's leveled off. It's been around the 500 million ounce round numbers for quite some time and leveled off. And it really hasn't varied that much. I mean, people make a big deal about, industrial demand's falling off, but or increasing. But we haven't seen a substantive increase other than the one I just outlined, where we went from I forget the exact numbers, I want to get the correct idea, but 350 million ounces on the industrial side up to 500 million or 550 million ounces on the industrial side. And they're again, to repeat, leveled at that area for quite some time. Now we're looking at an increase of about roughly 25% basis this this paper put out by the Silver Institute that was prepared by this group, CRU, and that's available on the web. It's an independent authority, and they did a pretty good study on the silver market. It's pretty similar to the 10-year analysis I did back in 2010. And so this would be substantive on the demand side, and they cover, silver and batteries, aluminum oxide, automotive, brazing and solders, printed circuits. But primarily the driver, again, in all that is photovoltaics. And the study that I used for photovoltaics that showed that we would be using approximately 130 or 140 million ounces of silver on an annual basis in photovoltaics was fairly accurate for the first few years, from 2010 to say 2012 or so, but fell off. And it really wasn't because the demand for solar panels had fallen off. What had fallen off, or what has taken place, is that the amount of silver used per panel has decreased substantially, which is pure economics. I mean, that's true of any business. You basically want to use as little of the product as possible, especially if it's a commodity that's fairly high priced, and make the end product very, very reliable, very long life, and that type of thing. So what happened is that the increased demand on solar panels, the manufacturers began to look at them, on ways that they could improve, and they've improved them. And the improvement that uses less silver per panel. Nonetheless, the thirst for solar seems to be, according to the study, robust, and I believe that's true. And so you're going to see a driver on the industrial side. And I think that a lot of the drivers on the industrial side are not that economic dependent. A lot of people say, well, David, that sounds great, but, we're, at the prefaces of another, global downturn or whatever, and it certainly seems to be the case, and I agree with that. But a lot of these areas, photovoltaics in particular, printed circuits. I mean, the reason that this study shows what it does is that silver is being used in these products because it's the best available and the most economic available. So in other words, if you want to save money in making these products, you're going to want to use silver in the application. So I'm very, not overly, bullish about it, but very bullish. I mean, I think it's realistic. In other words, I don't think it's overstating the case. It could be. I mean, you got to remember who you're talking to. Rather much, one of the bigger bulls in the silver market out there. But nonetheless, after having read the study like 3 times, I think that their projections are actually, I would say they're not conservative, but I don't think they overstate the case at all. I think it's rather significantly well-thought research. So I think that this is a very good factor for the silver demand. But one thing I'd like to go on to ask is, on the demand side, is what I've been alluding to, and that's a downturn in the global economy. I mean, if you could take away 70% of the supply in any market, then obviously you've had a big supply disruption. And people fail to realize, some, I mean, very studied silver bulls know this, but 70% of the silver market is a result of base metal mining. So if we have a very large global pullback, and it certainly looks like we will, with 70 million apartments built in China that are unoccupied. I mean, talk about misallocation of capital. And China being the main driver for the commodities, generally speaking, not only the energy markets, but aluminum and tin and lead, zinc, copper. But that demand subsiding in a rather significant way, you're going to see not only less demand, you're going to see less supply because the demand isn't there. And what that could indicate is that there'll be less silver coming to the surface as a result of base metal mining. If there's a big degradation in the amount of lead, zinc, and copper that's demanded on a global basis, then there'll be less silver coming to the surface. So again, that's 70% of the market. So you've got that factor, and you also have the fact that most primary silver producers, making up the other 25% of the market, are underwater. I mean, there's a few out there that can make money at $10 silver. But you put those on one hand, and there's a couple of fingers left over. The rest of them were marginal around $20, but they're not able to sustain forever at these prices. So that, again, I'm not saying could curtail the market, even on the primary silver producers. So we have a situation where the price is dictating a lot, the global economy is dictating a lot, the industrial side is dictating a lot, and for all those reasons combined, I see it as a synergy. I see an industrial demand increase, I see an investment demand increase, I see the institutional side having demand that's pent up that hasn't been realized yet. And then, of course, with the unfolding of the global situation being what it is, there could be a run to gold. And with the run to gold, then what you would see is a little sister silver going along with it. And since it's a smaller market and there's a lot of people that wouldn't be able to afford gold once it really gets going, they would spill over to the silver market. So I'm still rather bullish on the metals.
And we'll take a short break. More of our interview with David Morgan on the way. In the meantime, if you want to start investing, 1-877-8-SILVER. Go to guildhallwealth.com or therealmoneyshow.com. While you're on guildhallwealth.com, a reminder, click on the e-store, and for every 100-ounce bar of silver you purchase now, you will receive one silver maple. And back with more of our interview with David Morgan right here on The Real Money Show.
And I think that it's a very valid point when you're discussing the extension, by extension, the demand side of the market. If there is a global slowdown coming, and we can expect that there's going to be some type of liquidity crunch similar to 2008, do you think sentiment is different this time around with investors? Do you think they have enough common sense to move into better assets like silver, let's say, or gold, for that matter, prior to this occurring? Or does the same thing happen again? We trail down, and then, of course, silver and gold end up being the fastest two assets to recover?
The honest answer is I don't know.
Right.
I say that with a lot of conviction. If you go back to the 2008 crisis, I was right there and had a pretty big silver position. And when it came down, I was not happy. And also a bit surprised. I thought silver could probably go, so it's excused that silver's more of an industrial metal, and so if the stock market sells off hard, silver's going to go with it and all that. And I get all that. And there's some validity to that. But gold fell off as well. Obviously not as much as silver. It's a bigger market. But I was surprised. I still thought that gold might come down slightly or not move, or possibly go up against it, which is what most of the academics will tell you, me included, that that kind of a sell-off in the stock market and uncertainty in the market, the panic in the market, you would expect gold to at least hold its value and or go higher. That's not what happened. However, what did happen was that it recovered very, very quickly. But now you're asking, would it happen again? And I don't think it would. I mean, the answer I said, I'll repeat, I don't know. But the psychology of the market really has been beat up. I mean, silver's been in this bearish mode for like 4 years, and gold well over 3 now. And so the move of the silver and gold bulls, I mean, a lot of them have given up. I know some personally that had rather significant silver positions that basically threw in the towel at 25, 22 or under 20, and basically probably will never come back to the market. So we do need new buyers. The bulls that have conviction are holding. Certainly, they may be buying more, but they're waiting for various prices, and some of them may lighten up. I mean, if you're over committed to a market, and I stress that you shouldn't be. I really, as much as I like the metals for lots of reasons, it doesn't mean that that's the only asset class you should participate in. But regardless, people that are overcommitted may have, let's say, an average price of, let's just pick a number 26. That's a big psychological number in my studied view. So we get up to, let's say, they hold their position and say their average price is 26. So they get to 26 and, they got 50% of their net worth in silver. They might decide to lighten up. And I'm going to even, for example. So it's not going to be like 2008 coming back up, where it was so brief that most of the people just held, and as the price went up, you either bought more or held in the position. In this case, you've got a lot of what's called overhead resistance. So a lot of those people that are overcommitted or whatever will get to the point of break even, wherever that is for them individually, and see, silver stacks at 22, that's where I bought it, that was cheap, Morgan told me that was the cost of production for XYZ mining, and I have, if they get the report, they know some of the primary silver producers, what they exactly, what their exact costs are, with no fanfare and no BS, absolute truth. And so they bought it because of, our research, and they said, it's below that, now it's back to it, and I'm out. I don't want any more silver. I don't want anything to do with it. There's some of those people, and that's human nature. You can understand it. I understand it. I still think everyone should have a position in metals, and I firmly believe that, but that doesn't mean very many people agree with me. In fact, I got a 99% anti-mortgage contingency out there. Only 1% of the people out there actually believe in the metals and buy physical metal. So, it's a very, very small market. Nonetheless, that overhead resistance would caution me that you wouldn't see it similar. I think it'd have to ebb and flow and work its way up. But however, I must give a caveat to that statement. That's in normal market conditions, right? We're in anything but normal market conditions. So as an example, if things were starting to get even more, I've used the word bizarre in the currency markets. The reason I chose that word is it's meaningful. That with what's going on with the Russian ruble and being able to halt trading in some instances and going up to 17%, mines may be old enough to know what Volcker did with the U.S. dollar, which interest rates over 20%. Right. So with all that happening, I can't rule out that there could be a sudden run into gold or run into silver because of conditions that are once in a lifetime or once every 5 lifetimes type of scenario. And I won't rule that out. In fact, I actually think that the probability of that is actually quite high, much greater than a bell curve would normally show you. In other words, if you look at what's called the tail end of the curve, where you have a very low probability of this happening, you have to look at the conditions as they are. And the conditions as they are right now, the probability of some kind of an event are very, very high relative to what they are normally. So we're certainly not normal conditions. So because of that, I can't say that this overhead supply, et cetera, would basically mitigate the market, because if there was a panic buy for whatever reason, the people that owned it would hold it, and they might even buy more, and then they might tell their friends, their neighbors, and everybody else. All of a sudden, there's a run on gold, and so I don't want to misrepresent it either way. I want to be as clear and concise and precise as I possibly can, because it's important for people to think these things through. One of my favorite quotes is, "Chance favors the prepared mind." You have to look at every scenario, and nobody can. I can't, Jim Rickards, any of these people that are pretty thinkers in these markets. None of us have an exclusive, all-seeing, all-knowing probability. I mean, we have probabilities as back up, but what we don't have is an all-knowing knowledge of what could take place. We have basic scenarios, and you know what? The scenario that takes place is probably one that's different than any of us thought of. Looking back, why didn't I see that? Right. Why didn't I see that China would come in and tell Japan to do this or jump, drop the yen, not the dollar, but because the yen got dumped, it took the dollar. Or some other scenario, one I don't talk about often, and I know we can talk about them all day, and again, all could be incorrect, but the idea is correct, that we're in a situation now in a global financial empire that is so uncharted, unknown, and there's so many caveats to it that the authorities have taken, including U.S. citizenry on the back of the derivatives exposure. So we could bet if we're wrong, you pay for it. I mean, this is ridiculous, but this is what has taken place recently. So caution, caution, caution. If you're not in the metals, I think you should be. And again, a correct amount is an individual choice. I've always recommended 10% as a minimum. And I think in the current conditions, 20% really isn't excessive for most people. But beyond that, you can't get overexposed. And then if the metals continue to trend down or sideways for a while, people get discouraged rather easily. And there are people with long-term horizons and strong convictions, or others that just basically took a 10% position, some time ago. I mean, certainly my average price is pretty low, even though I bought, as high as 30 actually, but it wasn't a significant amount relatively to, what we hold. But nonetheless, the average price, because I began so early, is rather low relative to what the price has been.
Right.
So I'll probably beat that one to death. But that's a great question, because it's important to know that the black swan and all that people kind of make light of, they do happen, and they could happen. And the way things are going right now, with what's going on with the Russian ruble, what's going on in the energy markets. By the way, let me just add something very important.
Sure.
Out on the net. A lot of people don't know this, but what took down, or at least was pointed at historically for the takedown of the global financial crisis in 2008, was a subprime mortgage debt. And now the subprime oil debt is what I'll call it, which is all this fracking that's been going on, which is all in the junk bond market. So in other words, it's subsidized, similar to the way the mortgage market was subsidized, is underwater significantly. And that amount of debt is at least double than it is in the subprime market. So I want to be perfectly crystal clear and repeat myself here. The amount of derivatives exposure that caused the 2008 financial global crisis, that event, that's history. We're now in a position where we're weaker than ever. There's fewer banks than ever. And the global exposure in the derivative situation is twice as bad as it was there, and it's in a key element, as important or more important in my view, than shelter for living, and that is the energy markets. So we're in very thin ice as far as I'm concerned. This is something that people need to wake up and realize, because in my view, we could get to this kind of a situation where the run to gold is so strong, and a lot of these people that write on, what's considered the fringe, I don't consider it the fringe, but some people do, that, there's all this manipulation of the market, and, where's the gold, and how many times it has been hypothecated, re-hypothecated, it really owns it, etc. The point I want to make is that we could get in a situation where the physical market starts to seize up, or does seize up, and maybe only for a day or two, or a week or two, or counterparties cannot determine. There's a lot out there in this convoluted derivatives market, and if that were to occur, then there'd be a run to the secondary market. The secondary market isn't necessarily the futures and options market, it's the mining shares.
Right.
So you would see, could see a run into gold and silver like you've never seen in the history of mankind, especially if the physical market was starting to have problems with physical offtake or derivatives exposure, or both at the same time. In other words, multiple claims on certain on gold and silver that couldn't be determined, or had certain timelines on them that, you can't get your gold back until, September 2016. That's what the contract says, and, on it goes. So it's a very, very deep rabbit hole. It's one that I don't think any one analyst knows everything about. Certainly I've looked at as much as I possibly can. I've tried to separate the wheat from the chaff the whole time.
Sure.
But I can't give you an absolute, but I certainly have a good feeling for it. I'd say my feel for the market is probably as good as most. And I do it from both, from the bottom up. I do it from the retail investor standpoint all the way up, and the top-down analyst that I am. From the commodity only. What is silver? Why is silver important? Who would want silver? Why would they want silver? Et cetera. So I look at it from both directions. And I think, again, that gives me a rather different view than you might get from a Wall Street analyst who looks at silver and basically has, a huge derivatives book that helps, major producers hedge their positions, which I'm not against. I'm just saying that their viewpoint, certainly might not be as broad as mine is.
And we'll take a short break. More of our interview with David Morgan on the way. In the meantime, if you want to start investing, 1-877-8-SILVER. Go to guildhallwealth.com or therealmoneyshow.com. While you're on guildhallwealth.com, a reminder, click on the e-store, and for every 100-ounce bar of silver you purchase now, you will receive 1 silver maple. And back with more of our interview with David Morgan right here on The Real Money Show.
In terms of sentiment, if you look back at the 70s and what happened in the middle of the decade, I mean, I can imagine how many people kicked themselves in the rear end for having left behind the gold market only to see it flourish coming to the end of the decade. And of course, it was dramatic. I mean, with the drop in pricing, most people probably walked away from it like the sentiment is more recently been in terms of the silver and gold market. But I mean, as far as moving forward, this is why, and we've said the same thing too, that 10 to 20% in your portfolio that you might have in gold or silver in physical form is so prudent, it's so smart, because you don't know what's going to happen, and God forbid another major event does happen and there is something like this subprime oil that does come to fruition. We're watching it closely, but if it does, it's going to be a horrid thing, and I don't want anybody to think that that's what we're going to relive, but I mean, it does put the emphasis on understanding the importance of having assets like gold and silver in the portfolio. So for 2015, David, before we let everybody know how to get in touch with you, what is the best case scenario for David Morgan in terms of what silver and gold might be doing?
Yes, I'm going to answer that, backing up what you said.
Sure.
Back to the last market, you saw, gold, go from its fixed price all the way up to around 200 and then fall off to 100. And it took quite some time to get back up to that 200 level. And again, using my analogy earlier, that there are people that bought probably at that top, 200-ish. And then when it finally worked its way back to that level, sold out because they were broke even and they were tired because they watched it, lose 50% of their investment value based on maybe dollars or something, round numbers, back up to $200 got out. But once it made that $200, came back up to that level, accelerated from there to 800. Did a fourfold increase in a rather small amount of time. Silver, on the other hand, did even better. It started in 1979 at $6, and then in January 1979 at $6, and in January 1980, around went up to $50. So you have like an 8-fold increase. So one thing that I might take a look, the Silver Manifesto, that will be out early in 2015. And I wrote this book because I really believe that this is the time that people that have been waiting on the sidelines understand we're starting to pick up. And I want everyone to really out to water, sit down, and have them position nonetheless. And hopefully it will work ahead to this home. Regardless, my point being is that something that I actually got from Jeff Christian was in the end, stating that 90% people are running the gold and running the silver for whatever reason or reasons that it's an acceleration phase. So you want to be in early. You don't want to be in that manic buying phase where maybe this time you can't even get it, or you can only get it in retail quantity size. You can't get it significantly as a hedge fund manager. We're Sprott, for example, wanting to buy another 20 or 30 million ounces of physical silver. Can't obtain. Now, I'm not stating that's the case. I just want to give the idea.
Sure.
Once these panic buys start, that things change. And it can change rather rapidly. So where do I see 2015? I see 2015 as a moderately uptrending year, if everything holds together as it is, with no black swans involved. So I think we're going to work our way back. I would see, what I really want to see for a psychological perspective, price-wise as well as price. I'd like to see gold above 15, 26 on silver to get over that breakdown point that was so significant and it's held now for quite some time, where, again, I think the psychology of the market was beaten up enough to where a lot of people that wanted to buy decided to leave, to not participate in the market. And those that told themselves that they would buy low really haven't. Going back to my Chance Davis prepared mind, if you are of the idea that, geez, you really want to hold out and buy when it got low, well, now's your opportunity. I am ringing the bell. I am stating so. Is this exact bottom? I don't know. What I do know is if you could buy any commodity under the cost of production and have some patience, you're going to make money. And that's true of both gold and silver, particularly the silver market right now. Should you own silver or gold? I think you should own both. I think the older you are and the more conservative you are, the more you should favor gold. I think the younger, more aggressive, and the more risk tolerant that you are, the more you should favor silver. So I think I'll conclude with that.
If you're enjoying the interview with David Morgan this afternoon, we'll get to more of that in just a sec. I want to remind you to start investing. It's 1-877-8-SILVER. Go to guildhallwealth.com, click on the e-store. And right now, every 100-ounce bar of silver you purchase, you will receive one silver maple.
Well, David, I mean, it's been a pleasure. And again, you're very insightful. We've taken your advice year and year and year, one after the other. And to have you spell out some of the pitfalls and to talk about what is your expectation for the coming months is awesome, and we do thank you for it. How can our listeners get in touch with you, David, and use some of your services?
Well, first thing I'd like to encourage everyone to do is occasionally visit our website. It's not a static website. If you put up videos every week or so, there's one on there right now that's going to be up for another couple of hours, and it's regarding a movie. I've used these movie clips in the past to make a point, but it talks about the Russian ruble and what the Russians have done with their foreign currency exchange and basically sandbagging the U.S. dollar. Could be pertinent, could not. I'm not really forecasting. It has meaning. It has meaning from the aspect that it causes people to think. So I'd encourage people to just go to the website, silver-investor.com, and check it out probably on a weekly basis. If you want to follow all my work that's in the public domain, you can go to Silver Guru on YouTube. If you want to see everything I read that I think is important to not only the metals markets but the general economic conditions, then you can follow us at Silver Guru 22 on Twitter. That's put up there myself personally and a couple of our staff members, and that's all who has access to post on our Twitter account. But if you're really following the markets closely, you can see basically if I read 10 articles and these are the top 2 articles I think people should see, I just send them on a Twitter feed. I'm not really interested in people knowing if I'm having a latte or not. That doesn't interest me at all. Twitter for that. Also, if you go to the webpage, silver-investor.com, if you're there the first time, it's a pop-up window. It only bothers you once. You can get our free e-alert letter. I really think that that's important going forward because we do a weekly wrap-up, and we give out the interviews like this for everybody, and it's free. And we also give insights, and we take questions from all viewers and only our paid members. So those are all free available. If you're serious about the metals market, we do leave our best thinking and our consultations and that type of thing in the Morgan Report itself. There's 3 levels of service, and that's described on the right-hand side. And, if you really have questions or whatever, I mean, at this point in time, with our business down rather significantly, occasionally, I'm not going to say I do this in every case, but occasionally I'll actually pick up the phone myself if I have the time and can, talk to people. I usually give them like 5 minutes or so. But we do consulting. I've consulted with people that I can't name that are rather significant in the industry, not only the silver mining side, which you can probably guess, but also significant on the institutional side. In fact, I'll just brag slightly that there was a gentleman that visited Bill Gross some years ago before Bill left Minto that he started. And after visiting Bill, he called me and took a rather substantial silver position. And that always raised my eyebrows in a way because, the bond market is the keys to the kingdom. It's the debt market that's the big problem lies in. And I think anyone that knows anything about finance understands that. And this is where the problems are starting to show right now, this all call it being a currency war with the Russian ruble. So interesting times. Again, I don't think 2015 is going to be that significant. I think it'll be higher. I think things will probably hold together. It's hard to know, but you'd rather be early than slowly get done.
Well, listen, David, we thank you very much for your time. I hope you have a wonderful holiday season with you and your family, and try to get some rest, because I know you're thinking very hard about this market and answering a lot of questions from people. So thanks again for being a contributor here on the show, and we look forward to speaking with you in the new year.
Thank you. My pleasure.
All right, take care.